Last month, I was making $1,985 monthly from my $100,000 3 ETF portfolio. After some strategic rebalancing, I'm now generating $2,243 monthly. That's a $258 increase just from reshuffling my positions. First, let's talk about HHIS, the Harvest Diversified High Income Shares ETF. I significantly boosted this position to $40,000, making it my largest holding. HHIS is currently yielding about 23.83% annually and owns a diversified portfolio of Harvest single stock ETFs focused on companies like Nvidia, Tesla, and Palantir. Each underlying ETF uses covered call strategies to generate high monthly distributions, and the fund employs 25% leverage to amplify returns. This gives me exposure to the hottest growth stocks while still generating substantial monthly income. At $40,000 invested, this generates $9,532 annually or $794 every month. And the beauty of HHIS is that you get exposure to multiple high growth companies rather than betting everything on one stock while still maintaining that massive yield. And really quick, I've noticed 80% of you who watch these videos haven't subscribed. An easy way to support this channel for free is to hit that subscribe button. It not only helps the channel grow, but lets me know that you want to see more content like this. All right, next up is UMAX, the Hamilton Utilities Yield Maximizer ETF. I sold off a portion of this position, but I kept this position steady at $35,000. UMAX currently pays 14.44% annually and focuses on Canadian utility companies, power companies, telecoms, and pipeline operators that provide essential services people need regardless of economic conditions. UMAX uses an active covered call strategy managed by experienced option traders to generate income on top of that regular utility dividend. It's the most conservative holding in my portfolio, providing steady monthly income without leverage. At $35,000 invested, this generates $5,054 annually or $421 every month. While the yield is lower than my other holdings, utilities provide stability and tend to perform well during market uncertainty. And I'll speak more about my plans for UMAX a bit later in this video. Now, here's where I made my boldest move. I allocated $25,000 to MSTE, the Harvest MicroStrategy Enhanced High Income ETF. This ETF is the heavy hitter in my portfolio, currently yielding approximately 49.35% annually. MST focuses on MicroStrategy, which is essentially a Bitcoin treasury company that's been aggressively buying Bitcoin. The fund uses covered call strategies on MicroStrategy stock plus 25% leverage to generate these massive monthly payments. Since MicroStrategy moves with Bitcoin's volatility, the covered call premiums are enormous when crypto is moving around a lot. At $25,000 invested, this generates $12,338 annually or $1,028 every month. That's over $1,000 monthly from just one position, though it comes with significant volatility since it's essentially tracking Bitcoin's wild price swings through MicroStrategy. So here's my updated allocation across all 3 ETFs. HHIS at $40,000, generating $794 monthly, UMAX at $35,000, generating $421 monthly, and MST at $25,000, generating $1,020 monthly. That's a total monthly income of $2,243. That's up from $1,985 last month, representing 13% increase in monthly cash flow. That total represents 26.9% annual yield on my $100,000 portfolio. And you can calculate this yourself with the free investment calculator in the description and first pinned comment below. Now, here's exactly what I did to achieve this increase. I rebalanced my entire portfolio to focus on the 3 highest yielding opportunities. I increased my HHIS position significantly, maintained my UMAX for stability, and added MSTE as my high risk, high reward position. And you might notice I'm keeping my total investment at exactly $100,000, and there is a strategic reason for this. This $100K was originally from my emergency fund, so I'm only reinvesting enough each month to keep my portfolio value at $100,000, and any excess distributions are being set aside for taxes on this portion of my portfolio since it's in a non-registered account, and also helping build up a second emergency fund until I get it to a level that I'm comfortable with. Now, once I reach my target emergency fund balance and I get my overall portfolio allocation where I want it, I'll start letting this dividend portfolio grow beyond the 100K mark with the intention of getting this portion of my portfolio to pay me out $10,000 a month. That is the ultimate goal for all of this. But right now, this approach lets me capture the high monthly income while still being responsible about my overall financial picture. Because the goal isn't just maximum yield, it's sustainable income that fits into my broader financial strategy. Remember, this $100,000 represents money I'm not using for long-term growth investing. It's essentially replacing what would normally be placed in a high interest savings account earning 5%. And since I need this money to stay relatively liquid for the time being, I'm willing to take on more short-term volatility in exchange for dramatically higher income. The increased position in HHIS gives me diversified exposure to growth stocks. UMAX provides stability from Canadian utilities, and MSTE offers the highest yield potential tied to Bitcoin's momentum. And now, speaking of UMAX, I will continue to lower my position here, especially next month when I plan on adding one more ETF to this whole mix. Now, let me be completely honest about the risk here. MSTE and HHIS are extremely volatile because they use leverage and focus on high growth, high volatility stocks. MSTE essentially moves with Bitcoin. So if crypto crashes, this position will get hammered. And I need to emphasize that I am only taking these higher risks because I already have my TFSA and RRSPs maxed out with traditional index fund ETFs, plus a corporate account loaded with broad market ETFs and highly profitable stocks. So this 100K high yield experiment represents only a small percentage of my total portfolio and not my core strategy. My standard advice remains the same. If you're 10 or more years from retirement, stick to traditional index funds like VFV or VOO. This high yield approach is not what I recommend for most people's primary investment strategy. The high yields from these covered call ETFs often include return of capital, which isn't taxed immediately but reduces your cost basis. This means bigger capital gains when you eventually sell. For TFSA investors, this doesn't matter. But if you're holding these in taxable accounts like I am, track this carefully. Also, these yields aren't guaranteed. They fluctuate based on market volatility and how much premium the funds can collect from selling covered calls. When the markets are calm, the yields drop. When the markets are volatile, yields can be even higher than what I'm showing right now. So rather than making these changes all at once, I dollar cost averaged into the new positions over the past month. This helped smooth out some of that volatility, especially with MSTE, which can swing wildly day to day. So for now, my current reinvestment strategy is focused on maintaining the 100K balance rather than maximizing compound growth for now. This gives me flexibility to redirect that excess income towards my new emergency fund and for taxes that I'll be paying on all of this. It's ideal for people approaching retirement, those with shorter time horizons, but I do not recommend anyone do what I am doing, which is using my emergency fund for this investment strategy. If you have an emergency fund, place it in a GIC or an HISA and just watch my monthly video series to see how I perform. And just so you know, like I said before, I am building up a second emergency fund for a reason, because I do not have enough data to prove whether or not this is even a good strategy at all. But we'll find out with this video series, won't we? And also, covered calls are not suitable for young investors with a 20+ year timeline. They should focus on growth. It's also not for conservative investors who can't handle daily volatility. And these ETFs can swing 5-10% in a single day. Now, with that giant disclaimer out of the way, I'll continue doing these monthly updates to show real performance, including any changes to the yield and how the portfolio handles different market conditions. It's important to see how these strategies perform through various market strategies, not just during favorable periods. And the key is to understanding that while the income is attractive, you're trading potential long-term capital appreciation for current cash flow. So make sure this aligns with your financial goals and risk tolerance. And please remember, this is an experiment with money that I can afford to be volatile with. And I've been strategic about not letting this portfolio grow beyond 100K until I'm comfortable with my broader financial position. Don't invest money you need for essential expenses or long-term goals in these high yield, high risk strategies. Now check out these two videos and I'll see you next month with another update on how this portfolio performed. Bye guys.